So, a lot of high net worth professionals are on the move. They're leaving traditional offices and high tax states behind. But as they settle into their new lives, many are discovering a pretty painful financial surprise. Their state tax liabilities, well, they didn't move with them, especially when it comes to stock compensation. This is a hidden financial trap, and it's called trailing nexus. Today, we're going to break down exactly how it works.
So you did it. You packed up, you left California for Texas, or maybe you traded New York for Florida. You've got the new driver's license, you registered to vote, and you are loving that zero state income tax life. You figure when that big RSU grant finally vests, you're totally in the clear, right? Well, think again. The state you left behind has a very, very long memory, and it hasn't forgotten about you or your stock. All right, here's our game plan for this deep dive. First, we'll define the trailing nexus trap itself. Then we'll get into how states can legally get away with this. After that, we'll walk through the exact math they use to calculate what you owe. We'll also highlight the most aggressive states, the real danger zones. And we'll wrap up with common payroll errors and some planning strategies you can actually use. Okay, Section 1, the trailing nexus trap. The whole concept is built on this really powerful illusion, this idea that just by physically moving to a place like Texas or Florida, you've automatically cut all your tax ties with your old high-tax state. As we're about to see, that is a very, very costly misunderstanding. So, what is this trailing nexus thing anyway? Think of it like a legal tether. It's the principle that lets a state tax you on money you get today simply because you earned it while you were living there in the past. Your stock options, your RSUs, they didn't just pop into existence the day they vested. No, you earned them over years of work, and that old state wants its cut for the time you were on its soil. So the big question is, how is this even legal? I mean, you don't live there anymore. Well, it all comes down to two totally separate powers that states have to tax your income. They're called residency and source, and you have to understand the difference between these two. And here's the critical switcheroo. While you were a resident, let's say in California, they used their residency power. That means they taxed you on your worldwide income no matter where you earned it. Simple. But the moment you leave, they pivot. They flip the script and start using their source power. Now, as a non-resident, they tax you on any income that was sourced to the work you physically did inside their borders. Now, before you think about calling up a lawyer to fight this, let me just save you some time and money. Taxpayers have tried, and they have consistently lost. The courts have said over and over that the minimum connection the Constitution requires was established way back when you were living and working in that state. The fact that you get paid years later when you're living 1,000 miles away, legally, that's completely irrelevant. All right, so the states have the legal right, but how do they figure out exactly how much of your stock income they get to tax? This is where we get into the nitty-gritty, the technical core of this whole thing, the allocation mathematics. It all boils down to a very specific formula. So everything hinges on this one thing, the allocation ratio. And you know what? It's actually surprisingly simple. The top of the fraction, the numerator, is the number of days you worked in the high-tax state during the vesting period. The bottom of the fraction, the denominator, is the total number of workdays in that entire vesting period, no matter where you are. That's it. That simple fraction determines the state's claim on your money. And here's the final step. Once you have that ratio, that percentage, you just take the total income you got from the stock, whether it was an RSU vest or an option exercise, and you multiply it by that allocation ratio. The result is the exact dollar amount your old state is going to send you a bill for, even though you're now a non-resident. But, and this is a really, really important but, that allocation period, the denominator in our formula, it changes based on the type of equity you have. For RSUs, it's pretty clean, from the day they're granted to the day they vest. But for something like a non-qualified stock option, an NSO, the period can be way longer. It runs from the grant date all the way to the day you actually exercise them, and that little difference can completely change the math. Now, I hear this argument all the time. People say, hey, wait a minute. My stock price went to the moon after I moved to Texas. California can only tax the value from when I live there, right? Wrong. The California Office of Tax Appeals shot this idea down hard in a landmark case called the Appeal of Prince. They ruled that RSUs are compensation for your labor. They are not an investment, so the state gets to apply its ratio to the entire value when it vests, capturing all that appreciation that happened after you left. Okay, so we've got the basic formula down. Now let's talk about the real danger zones, because not all states are created equal here. Some have come up with their own unique and frankly much more punitive rules. They are the apex predators of sourcing taxation. Let's start with California's reverse credit. This one is, well, it's devious. Normally, your new home state, let's say Arizona, gives you a credit for taxes you paid to your old state, California. But California hijacks this whole process. It forces itself to be the one to give the credit. So it gives you a credit for the lower tax you paid to Arizona, which is basically worthless. The result? You still end up paying the full high California tax rate on that sourced income. And California has another nasty surprise, especially for people with incentive stock options, or ISOs. It's called the AMT trap. When you exercise your ISOs as a non-resident, it can trigger California's alternative minimum tax. So you have to pay this big tax bill up front, and in return, you get a tax credit you can use in future years. But here's the trap. If you never have significant California income again, that credit is useless. It just evaporates. It becomes a permanent sunk cost. Money you'll never see again. And then there's New York. Oh, New York. They're in a league of their own with something called the convenience of the employer rule. Here's how it works. If your office is in New York, but you choose to work remotely from, say, Connecticut, just because you want to, New York says, nope, those are New York workdays. This can lead to them sourcing 100% of your equity to New York, even if you were barely there, creating a huge risk of double taxation. Finally, let's talk about Pennsylvania's trap. It all comes down to the fact that they just don't follow the federal tax rules for incentive stock options, specifically IRC Section 422. This creates a really painful mismatch. You pay ordinary income tax to Pennsylvania when you exercise your options. Then later, when you sell the stock, you could also pay federal capital gains tax. You're getting hit twice on the same gain, with almost no way to fix it. So after all that doom and gloom, you're probably asking, okay, what on earth can I do about all this? That's a great question, and it brings us to our final section, dealing with common employer errors and looking at some proactive strategies you can use to mitigate the damage. You know, the most common problem actually starts with your own company's payroll department. You move to Texas, they update your address in the system, and when your RSUs vest, they withhold 0 state tax. Their software often isn't smart enough to look back and calculate the portion that's sourced to California. So what happens? 2-3 years down the road, you get a nasty letter from California for all that unpaid tax, plus interest and penalties. The fix is to get ahead of it. You need to ask your employer for a corrected W-2, that's a Form W-2C, that properly reports the income and withholding to California. But it's not all about fixing mistakes. There are some smart, proactive moves you can make. First, and this is the most powerful one, timing. If you can move and establish residency in your new state before you get a major new equity grant, the future allocation to your old state for that grant will be 0. Second, for stock options, be aware of repricing. That often counts as a brand new grant, which can reset the allocation clock in your favor. And finally, for those of you with ISOs leaving California, if you hold the stock long enough to meet the federal rules, you can sometimes convert what would have been California-sourced income into capital gains that are sourced to your new tax-free home state. Let's just put some real numbers on this to see how hard it can hit. Imagine an executive who moves from California to Texas. They're 2/3 of the way through a vesting period for $1 million in RSUs. Even though they've been a happy Texas resident for a full year, when that stock vests, California's allocation ratio is 2/3. That means California sources almost $670,000 of that income back to itself. The result? A surprise tax bill for about $80,000. So, at the end of the day, it all comes down to this one question. You've changed your address, sure. You've changed your residency, you've changed your lifestyle, but you can't go back in time. Have you changed the source of your labor? Forgetting that distinction is truly one of the most expensive mistakes a mobile professional can make.